All right, folks. Trisha Curtis here, CEO of PetrroNerds and host of the PetrroNerds podcast. Welcome back to the PetrroNerds podcast. This is episode 91 of the PetrroNerds podcast. I am super pumped about it, and I'm pumped about all episodes, but we're nearing to that 100 mark, so I'm getting pretty excited. But today is Wednesday, August 16th, 2023. There is a massive amount of data and intel and market volatility taking place right now. If you've seen commodity prices, whether that's oil prices or copper, or heard about Fed minutes coming out from the Federal Reserve, or treasury yields, or all the slug of data that has come out in the last couple of days on China, you are probably relatively overwhelmed. So the PetroNerds podcast has you covered, as does PetroNerds. I walk my clients through this on a detailed basis, but we are going to dive into a massive amount of data and information today. And this is really a podcast about the U.S. economy and all the information coming out of the U.S. and China. We are going to start focusing really heavily on China and talking about a ton of information and giving you some background and color of what's going on in China and why this looming recession is really far closer than, it may be taking a while for it to really impact and really hit and punch, but it's far closer and it's much more of a reality than people think. So to begin with the data and the timestamps, we're adding a couple new ones. But WTI right now is 79.14. We're seeing Brent at 83.45. Obviously, we've come off significantly from this. Touching $83 on WTI. We have come off in the last couple weeks, and we're definitely, that is despite geopolitical volatility, the stuff that Russia has been pulling in the Black Sea, the ongoing war in Ukraine really actually heating up with many regards. And that is despite actually seeing declining inventories in the U.S. So we're really seeing some softening, which is based on thinner than normal trading volumes because it's August and it's summer months, and so we see thinner trading volumes, which Bloomberg is not actually reporting anymore. And it's we are also seeing a lot of this weakness in China really driving fears and concerns, and probably a lot of algorithmic and computerized trading as well. So Henry Hub 260. We are seeing Dutch TTF at 1210. So we have seen some recovery in Dutch TTF, and that is largely driven on what's happening with potential strikes and issues within Australia. So if some of that stuff, if they're striking on the LNG side, and people are, we're seeing them not reaching a mediation or a particular negotiation, and we see LNG come offline in Australia. Remember that Qatar, Australia, and the U.S., we all export about the same amount. It's roughly 12, 13 BCF a day that we're all exporting to the global market. And that is it's a 50, as of 2021, that was a 50 BCF a day global LNG market. All of us are sort of equal right now in those exports. So if some of that comes offline because of wage issues, and which is happening all over the world, but if some of that comes offline, that means potential serious price increases, especially for Europe, which is why we're seeing Dutch TTF and dollars per MMBTU rise, is because that means that China would be taking the same amount, and then as Europe is the marginal buyer, and those prices are going to go up. So we are seeing, if you look at the futures prices, and I caution, always caution clients as well as listeners on futures prices, because futures prices are just an indicator of what the market is telling you they think the future prices are today, and those shift on a daily basis. So if tomorrow natural gas prices, Dutch TTF goes down, those future prices are likely to go down with it. However, that being said, future prices right now for January of 2024 are at $18. So they are telling us right now that there's concern in the market. And there are reasons you can use futures prices as an indicator for how people are thinking about the market, and it's useful to look at. So with that being said, we also have potential for Australia. If you saw the Tellurian note today, they put a little note out, and it was talking about Western Australia potentially not being able to export Western LNG. So that LNG would have to be absorbed by Western Australia. That would have implications to the market for sure. And our other timestamps, I'm adding copper to this. I'm going to get to the 10-year yield and the 30-year mortgage rate, because that is a big portion of this podcast, talking about the U.S. economy and all that data. But the copper prices, I think, are really important to talk about, because they are, as a commodity, and just like crude oil, they are a potential forward-looking indicator for recession. And I don't think enough people and economists are really paying attention to the softness we're seeing in some of these commodity prices. So if you're looking at copper prices, you will see that they have really seen they had this massive spike up post 2020, and a lot of that is I believe a lot of that is hype driven, right? That was post COVID recovery, but how much that post COVID recovery will we really rip roaring. I mean, in the US for sure, building stuff, but use it for all kinds of components. And it is a big portion of it is a big portion of industrial consumption as well as housing and construction. So the fact that we're seeing some real softness in copper prices tells us a lot about what's actually going on in China. And it should be telling us a lot about what the economy is going to look like in the future as well, meaning recession is coming because commodity prices tend to indicate that. Okay, so copper prices right now are at $3.70 per pound. Now, if for context, if you look at March of 2022, they were nearing basically $5 per pound. Around $5 per pound. And then we've come off as of July 31st, we were about $4 per pound. So you can see that we've had some weakness and erosion. And if you look at those charts, they're not completely dissimilar than crude oil. So we've definitely seen that. That's something to pay attention to. Put that in your back pocket. If you're flipping through articles, whether, in various news sources, you will see a lot of copper connection in terms of the components of how it makes up and how much it's used in the property sector within China. And obviously with Chinese property data this week being really poor and sales coming down, not just for property, retail sales, you name it, everything coming off in China, but definitely on the property side, copper is a very relevant indicator right now. Okay, and then the US we have, which we'll be getting into in more depth, but I have to timestamp this with, we are seeing the 30-year mortgage, fixed rate mortgage at 7.34%. That is a massive amount. And I have done some calculations for you just to put this in context, because of how much of a price increase this is and why this is so important to think about in terms of the US economy and the US consumer. Along with this rise, the reason we're seeing this rate increase in mortgages is really on the back of the 10-year yield. So if you were looking at US Treasuries, or you're looking at yields, Treasury yields, you are seeing the 3-month up, you're seeing the 6-month up. So they're almost about the same. They're almost 550. You're seeing for the 6-month Treasury, about 544 for the 3-month Treasury. 12-month Treasury is at 536, but the 10-year Treasury is at 425, and that's really what folks are paying attention to. They're looking at the 2-year and the 10-year and those inversions and what they mean for recession indicators. But that 10-year at 425 is what is driving. That has really gone up, and that's what's driving the 30-year mortgage rate, which is highly correlated, is driving that up. And just to put in this perspective, and we'll come back to lots of stuff going on in the U.S. economy, but I want to front load this with put this in the back of your mind of the rate increases of 7.34% in comparison to, say, 3%, which is what a lot of folks tied their mortgages to, or say even 4%. So I put this in a mortgage calculator. This does not include your HOA or your mortgage, insurance or anything like that. It's just principal and interest. So for a $500,000 mortgage, and yes, a lot of people do have $500,000 mortgages, but those are probably lessening given that it might be a jumbo mortgage. A $500,000 mortgage at 4% interest at a 30-year fixed rate. The total cost is $859,000 and change. The total interest is $359,000 and change, and your payment is your monthly payment, again, just principals and interest, is about $2,400 a month. It's $2,387 per month. That's at 4%. Okay. Now bring this up to and we were not at 4% that long ago. We're talking months ago, we were at 4%, and now we are at 7.34%. So if you put in that mortgage calculator of that $500,000 a month loan that you're taking out, this is why we're seeing housing in the state that it's in right now. That is a total cost of $1.238 million and change. And it is a total interest cost of $738,000 and change. So nearly $1 million in interest. And a payment of $3,441 per month. So you can see that's a $1,000 a month payment increase, not including all the other things. So that's already, $1,000 a month more. You are starting to get you're knocking people out that aren't going to have the credit scores, not going to be qualified, or not making enough money. And again, lots of people have been doing this, right? We still see mortgages taking place, but if you look at mortgage applications in the U.S., they've dropped significantly. If you look at actual refinancing, they've dropped massively. And then we're starting to see this downtrend in housing. It's been very resilient. Housing prices still going up. we see that in shelter costs in the US and US inflation data. But what we're actually seeing is, I think we're starting to hit a point in the cycle and the point of how we're having higher interest rates that a lot of folks simply aren't not going to be approved to even have that. So you do see a lot of housing staying. Even Denver is still a very hot housing market, but those existing homes that they take a month or so to actually turn around. I mean, you just don't have the same as many offers because yes, the prices are roughly the same or haven't gone up dramatically in places hot like Denver, but your mortgage payments have gone up probably 1,000, if not more, a month. And that's really problematic when we think about where's the direction of the economy going. That works, or maybe works if everybody keeps their job. It doesn't if people start losing their jobs. So if everybody, and that's what we're actually seeing, and we'll keep on this housing trend, and I'm going to switch gears to inflation in just a second for the U.S. economy, and then we're going to dive into what's going on within China and why this all really matters for oil prices. So if we're thinking about the U.S. housing market and what you have seen a shift down, lots of pretty positive housing sentiment. There's if you're actually looking at the housing data in terms of apartment builds versus actual U.S. Single family home builds, they're telling a different story. And they're telling you that they are leading indicators of recession, and they're telling you that we've already tipped down into the single family homes. And also, these rising interest rates are impacting, they're going to start impacting the ability to actually borrow money and for construction. So we're still seeing construction of housing units, and that is probably problematic. It means that if we see this maintained interest rate prices, the affordability for a lot of people is just going to be completely priced out, and you're just not going to see housing move nearly as much. And that really starts impacting diesel demand and all kinds of other things, the demand that goes into housing. But you will start seeing that in demand for domestic diesel demand, and therefore for commodity prices and crude oil. And this housing data and these shelter costs are a huge component of U.S. inflation data. So, what you probably saw most recently, because we had U.S. inflation data come out last week, and but you saw today or the last 24 hours is UK inflation data. And something that the Fed actually mentioned in their Fed minutes was other countries and their inflation, and how this is what's going on with emerging markets and what's going on with other countries. But UK inflation data was 6.9%. It was in line somewhat with expectations, but it basically has not come down. You're seeing very, very high energy costs in the UK, very hotter than expected service costs. So basically, they are seeing the highest rate increase for labor costs in history, of the highest rate increase. So people are getting more money, but it's basically being offset with all this inflation, and that creates a potential wage price spiral, which is something we really, really do not want in the U.S. But something we are seeing very sticky and stubborn service cost inflation, which really has not come down massively. It's coming down a little bit, but not significantly. And that is the same with housing costs, with shelter costs. Shelter costs or housing costs are still at 7.7% for the latest inflation read in the US. So that is still up massively. We're not seeing that anywhere close to the 2% target for the Fed. And that means that creates this cycle that we've talked about in previous podcasts, and I talk about with clients, is that if you still have these very high housing costs, which are going to be maintained when you have these really high interest rates, and therefore you don't have a lot of people moving or putting houses on the market and a lot of inventory, then you're driving up rental costs as well. And we're seeing rental costs at incredible highs, which is really, really painful for people to just to live. Meaning most of their money, and Target talks about this in the earnings call, is that most of their money is going to the most important stuff, right? It's housing, it's food, and it's fuel, which means they don't have a lot of discretionary income to be spending other places. And that's why I think the data points when people are talking about, Beyonce's concerts and Taylor Swift and the Barbie movie and all this massive spending and the service sector, we have to be thinking about where is that money coming from, largely from credit card debt, I think, and where also what's going on within the economy to allow folks to have so much spending and so much craziness on experiences and on travel. And a lot of that is the work from home and the flexible work from home. And on the backdrop of that and behind that is that you're starting to really see some significant pushback by businesses who, yes, people want to work from home and they want that flexibility, but businesses are seeing that they are seeing lower productivity, and lower productivity is overweighing the ability to actually get people to work for them. So if you're offering people a flexible work from home lifestyle, the ability to get them to come into your work is great, but you're losing on the productivity side. So that's really important. And I think when we start thinking about all these data points collectively together, what's going on in the US, what's going on with China, credit card debt, spending, lack of productivity, this really starts weighing up into a picture that is not good for the overall economy, and in turn not good for oil prices. But to wrap up on U.S. inflation, we are seeing saw 3.2%. We are seeing a somewhat of a drop in U.S. inflation, but the sticky stuff, the core stuff in services and housing has been maintained, and it has really been led by this drop in energy. And unfortunately, last month, that drop wasn't as significant. So we're seeing, if you're looking at the month over month, we actually saw, energy prices come up a little bit. And so when we see oil prices coming up, that's a problem for headline inflation, but that's also, then that gets into food and everything. And so that's a problem globally. And I think what we're seeing is oil prices coming off is not necessarily a resistance to 86 Brent that we saw, but it is, there is something to realize that we don't have the same as healthy of an economy that we had a year ago in 2022. We don't have that now. So when we see rising oil prices in a deteriorating economy, that is problematic. And the reason oil prices have risen is largely from those OPEC cuts. It is not largely from this rampant demand driven. And I think we're seeing some real problems in terms of deciphering these oil price gains, and everyone's saying how great and resilient China has been over the last 6 months and first half of the year. And really, the reality that we're seeing in the data points, I don't think they add up. They truly don't. You cannot have the demand driven, rip roaring economy in China that has led the demand growth in oil, and also have stockpiling. And we have seen what we've seen China do is import a lot of Iranian crude oil. You've seen articles talk about that, where they're getting a $10 discount on Iranian crude at 1.5 million barrels per day that they're importing. The reality is all of Iranian's crude exports are going to China. That is 1.5 million barrels per day, if not more, if not pushing 2 million barrels per day at times. And that is way more. They're selling it at way more than a $10 discount. We don't know what they're selling it for. And then they're getting well north of 2 million barrels per day from Russia. And they are stockpiling a lot of this. So there's some really serious indicators. Now, China could be doing that for a couple of reasons. One is to protect, helping with inflation, capturing those gains why that stuff is cheap, but also fudging the data to make it look like they're importing a lot more and their economy is doing good. And it's also for resiliency. It is also for security and security of supply, so that they can weather different storms if they want to if they want to venture into Taiwan, or do a short protracted war in Taiwan or something like that, or blockade around Taiwan, that they would actually have crude oil security at least for a few months, because they have a lot of crude oil in stockpiles. And the data that comes in, that we're seeing, that the economy, that you're seeing the stock market sell off, you're seeing it sell off in China, you're seeing it sell off in the US, and you're seeing this really weigh on crude oil prices. And as I mentioned, we have thinner than normal. I mean, it's August, so we have thinner, traded volumes on crude oil. So these moves get exacerbated. But the fact that we had inventory drawdowns in the US, both on a product side and on a crude oil side, and we have this geopolitical risk premium really weighing on crude oil, especially with Russia in the Black Sea, and Russia, boarding a cargo on Sunday, but not doing anything. The fact that we have all this taking place and this ramp up in this war in Ukraine, and that's not where the momentum is for the market. The fact that we're still seeing that sell off in crude tells you there's stuff going on in China, and that's because, as I talk to folks about this a lot, is that all this data is out there, right? And so when we think of these black swan events, it's really not a black swan. The data's been out there. You're looking at a pond right now, and there's all these swans, and there's a black swan in there. It's been coming up to you for a while, but you just now seeing it, right? It's been there. And that's what happens when we have sell-offs or crises or anything, or contagion risks, is that typically it's just that the data is there and people really start paying attention to it. Now, the contagion risks within China are pretty serious, because the slug of data, and why I think this is so important to think about, is the slug of data is just bad, and it continues to be bad. And I'm not sure if everyone was just thinking, hey, it's going to get better, and they ripped off the zero COVID band-aid, and everyone was expecting that China would stimulate. I mean, apart from just giving people money and doing this helicopter money and doing what like the US did, they're not, that really probably wouldn't do much. They would have to be going on a massive growth spend and spending money and incurring lots more debt and building buildings that people aren't living in, to incur this. And they just don't have it. So the real problem within China is that retail sales are down, and housing is down. And so price decreases, and youth unemployment. I mean, we have lots of data points that are scary, but youth unemployment, which they put out last month at over 21%, youth unemployment, 21% is a really, really high number. It's higher than even other emerging markets. And China is a major economy, even though it is an emerging market in a developing country. That's a really, really high number. That number is probably not real. We know that China, the most economists and people actually within China would even say that it's probably between 30 and 40%. So that's a youth unemployment of ages 16 to 24 that could be as high as 30%, if not 40%. That's massive. That's basically 100 million people. And that's tens of millions of people that don't have work. Now, China said they were not just yesterday or within the past 48 hours, China said they weren't going to release that data point anymore. This is a lot of Chinese data that, they were releasing that they're not going to release anymore. We know that they were fudging those numbers before, but now they're not even going to try to fudge the numbers. You're just not going to see the data. So now they're saying they're not going to release the youth unemployment number because it's not a good indicator of the economy. And what's really sad is that when you listen to CNBC World and you hear the late night commentary, they go along with it and they're like, oh yeah, that's not a very good indicator. And you're like, what? This is one, it wasn't a very good indicator because it wasn't real, but holy crap, you need youth unemployment 16 to 24. It is telling you a lot. It's telling you that your recent graduates don't have jobs, which means that your economy is not growing and you're not adding to the workplace. And this is on the backdrop of these massive demographic issues where you don't have a lot of youth in China in the first place. So, or this rising, and you have a growing elderly population. And so what's happening when you hear retail sales and housing not doing well, what's happening is a lot of these people, and you're seeing some decent coverage by the BBC and actually the Economist on this of their podcasting, is you're hearing about the folks within China. You're hearing about students that were, have a master's degree from Columbia University in the US. They're going back to China. They can speak English. They can speak Chinese. They have a degree and they're thinking they're going to find a job and they're not even getting job interviews. And the jobs, they're basically saying, hey, you're going to work 6 days a week and you're going to work 12-hour days, and you're going to get a lot less pay because it's an employer's market right now. It is an employer's market because there's a lot of people applying for jobs, and these employers have the pick of the litter and they can pick whatever they want. So that's telling you a lot. It's telling you that, and we're hearing that these young people are just actually, they're living with their parents, which means their parents have this burden of having a young adult in their household. This is not dissimilar from what we saw in the US between 2008 and 2010 when we saw the peak unemployment, and throughout 2012 and when Obama came into office, he had this very sluggish economy because of all the lack of business incentives that were in place. And so we've experienced this in the US, and this is, thinking about what this means for China, what this means for the global economy. What you're actually seeing is all this stuff. The worries about this and the contagion is that if China slows down, yes, it's, we weren't really seeing the interpretation of, say, the Evergrande issues. We'll get into Country Garden in a moment. We weren't seeing that interpretation, I think, taken fully seriously into the market of what the contagion risk was, because people said, okay, well, maybe there's a property issue within China, but really with that spread to the rest of the world, it's pretty insulated, and China's been decoupling. Yes, but that means that China impacts Asia for sure. And so when you see Asia slow down, that has a real impact for oil prices, a real impact for commodity prices, because Asia is the developing part of the world. It's this global south, and the developing world those are the growth drivers for oil and commodities. And so if China is really slowing down to the extent that they could be and are, that means that we are going to see a slowdown in Asia as well. And the impact on these countries is going to be significant. And that is why I think you're seeing greater fears within the market. Okay, so with regards to China's housing slowdown, now we did see that. So Country Garden is the largest property developer. It was 2 years ago that you heard about Evergrande, which is the second largest property developer, and all these missing bond payments. And something you need to be putting in the back of your mind is that that China is putting through a few different things right now. It's that, they're taking haircuts. It's the foreigners that are taking haircuts, right? The foreign bondholders took all the haircuts so far on all those bond payments for Evergrande and all the other real estate entities and property developers that didn't make their payments, right? Those have been basically largely foreigners that have taken that. And then you have all these espionage laws being put into place right now where companies and individuals can actually get in trouble for basically giving foreigners intel or information. And so we are already hearing about parents or children talking about their parents or turning them in. Now, this is probably anecdotal. There's not a lot of validation to this, obviously, but it's pretty serious when we're starting to hear about this on even on an anecdotal basis. This harkens back to sort of the Cultural Revolution, not nearly to that extent in the Mao era, but the fact that it's taking place in the backdrop of a very weakening economy, I think is pretty serious. And we also saw there's a commentator that gets on CNBC pretty regularly, and I really disagree with his perspective because I think it's very, very biased toward his clients within China and elsewhere that have exposure to China. But he's an American. He's based in Shanghai. I've talked about him before. I'm blanking on the name of his consulting firm, but he was on CNBC the other night, and he was talking about how the blame for the economic concerns, this youth unemployment, the pains within the Chinese economy that he's seeing are actually going to the U.S. government, are going to the Biden administration and to America, because we're the ones that have imposed sanctions and these trade restrictions. And so the blame is going to us, and not to the Chinese government. And I'm sure that's what is being spun in what you're hearing within China. And that means that the risk of rising nationalism and the risk of needing to do something by the Chinese government rises sort of. I think that doesn't mean a threat of an invasion of Taiwan or a blockade of Taiwan is imminent, but it does mean that it's definitely rising. So, sorry, scooting back to the moving back to the Evergrande Country Garden thing. So, Country Garden, what happened last few days was that Country Garden said it is going to miss bond payments, or it likely is going to miss bond payments of several $billions. So Country Garden, the largest property developer in China, is going to miss bond payments. They suspended bond trading. And so that really did spook markets. And that was on the back of, housing price data that came in poor, and 2 months of lower housing price data. And this is in tandem with, restricting, not having the youth unemployment data. They did show the unemployment data, which retail sales was down. They showed unemployment north of 5%. That number is completely ridiculous. Just like youth unemployment, that actually only captures urban. So they have a thing called the Hoku system, where they designate the Chinese population designated as urban and rural. You still have several 100 million people in the rural category, and that's not captured within the unemployment data. So when you have 5.4%, if that was even real, that's just the urban population. That doesn't include the rural population, which could be much higher. And also, we know that's just a load of hogwash. That's not. We know it's well north of that. So all this data comes in, it's really poor, and then what we see is the contagion risk, not just for these Asian economies that people are starting to get concerned about, but the contagion that people are starting to talk about, and you're hearing in articles, is these shadow banks. And so they have names. I can't really pronounce them. I'm not even going to try. This one's pronounced the shadow bank that Bloomberg has an article you'll see elsewhere. It's a Zongrong. It's ZHONGRONG. So this entity basically is a shadow bank. It is a wealth entity that basically, grabs people's money, offered them a guaranteed 7%, and now is saying they're not going to pay them back. And has essentially come out and said, hey, because of the market, we're not going to be paying back these interest rates. So people aren't able to access their money. They're not getting the money that they were promised. And that means that if you just think about that, of how much money has been really tied up in this, the reality is that shadow banks were very heavily tied to the real estate sector, very tied to the property sector. The property sector is at least 1/5 of the Chinese economy. That has been, cratering for the last 3 years. So cumulatively, how well is the Chinese economy doing? Probably not very well, but we're just starting to these data points are really starting to sink in. And so if you have all the shadow banking where people were investing in this, and that now they're not getting their money out, this was it was a Ponzi scheme. Essentially, you had the property developers as well as wealth entities like this that were basically robbing Peter to pay Paul, and they're taking in money, they're promising, they're cycling it out, and they're doing these wealth entities and they're spinning it back out. It was working when property prices were going up, and these property developers were having you pay on your mortgage before your house was even built. And now those houses aren't getting built, and people have stopped paying on their mortgages. So now we have this whole cycle, this whole thing that was House of Cards is basically collapsing. And I think there was a lot of thinking that China could keep this going, and China could they could basically just throw a bunch of money at this and print a bunch of money and give it to their people, helicopter money, and then they could do this property stuff. And that may be enough for the non-intelligent investors on the US and Western side to say, oh, it's going to be fine for the next couple of years. But it doesn't really matter. The underlying weaknesses of the Chinese economy are really, really serious. And when you think about the complexities, what's happening within China with regards to these espionage laws that are taking place, and they do impact energy. So not just as the property sector and the collapse in prices and the real economy impacting energy prices and really telling us, are oil prices being somewhat artificially inflated right now, given that we don't know the extent to the weaknesses within China, and that maybe Chinese imports, a lot of this has been stockpiling, I think is a big question mark. But when we start thinking about what's also going in the energy space, that's really serious. So on the energy side, we have seen China, the state, Chinese state entities, the Communist Party, come out and say that they're restricting information for and concerned about information from the energy sector, the green energy sector, and the oil and gas sector, everything regarding energy leaking out. So they're concerned about those leaks. Now, that's important to think about in context of how important the energy sector has become to China. So I've talked about this at length in previous podcasts, talk about a lot with clients. But really, when you think about the coal consumption that China has, I mean, more coal consumption than any country in the entire world, more emissions than any country in the entire world, and how they really have energy security with regards to their grid reliability from a coal standpoint. That they are building out coal-fired power plants like gangbusters. They have over 5,000 terawatt hours of coal-fired power generation, and they're adding to this significantly for that energy security and producing all this coal. Now, they are also producing a massive amount of renewable energy, not just for domestic consumption, but for exports. And they were hoping and have said publicly that they would like to basically the same equate say their property sector is basically 2 trillion of the $2 trillion of the Chinese economy. They were hoping by 2025 that the green sector, the green economy, would be basically almost 2 trillion. 1.7 trillion dollars is what worth that as well. So basically they were looking to green energy to offset that. So it is important to think about this in context of how important this sector is, and so much of their exports have been green tech lately. I mean, whether it's electric vehicles or whether it's solar or wind power generation to Europe, they're exporting a massive amount of this. And this, yes, they're exporting a lot of this at a loss, and I'll talk about that in a second, but also ties them really tightly with Europe and keeps those ties really, really embedded, so that it's difficult for countries within Europe to sanction them or hurt them in any way, and detangle those ties. So it allows China to get away with a lot domestically, like the internment of Uyghurs, like forced labor, like very, very cheap labor for particularly these products that they're consuming. So you can see how it's important for them, and if they're making these concerns, if they're even talking about concerns about espionage or spying or intel coming out of the energy sector, and they're concerned about this, yes, this could be Chinese Communist Party paranoia and really not amount to much. But it also means that, one, they see energy as an important sector and they see vulnerabilities, and there are serious vulnerabilities there. If you are thinking about how you would hurt China, energy is an area where you could really hurt them. And it is something that they've always been concerned about in terms of their imports of crude oil, in terms of it's a reason why they do not produce and consume a lot of natural gas, because they don't produce it. They didn't want to import it. So they use very, very, very little natural gas, which is why their net zero plans and their green ambition plans are a load of absolute horse crap, because if they wanted to lower their emissions, they would be using natural gas in droves, which they're not. And they're not doing that because of energy security reasons. So when you're hearing about espionage concerns on the energy sector, and then you think about the importance of the energy sector to China, and being that China is the largest importer of oil in the world, this is really, really serious, and something that should be alarm bells should be hitting off people, and something to put, again, one of the many, many things I think to put in the back of your mind and back pocket. And something I actually just heard on, I don't love a lot of the BBC coverage on energy, because it it's very biased and tilts toward the climate change craziness in terms of the fears on global boiling and everything, and it's very biased in terms of the energy transition and the lack of reality of actual investment in the oil and gas space. However, you do always get a lot of interesting nuggets. And just today on the latest BBC World Business Report, they were talking about the 1 year on in the U.S. Inflation Reduction Act. And this is a nice little pivot to the U.S., which we'll get to. But this is a 1 year on into Joe Biden's Inflation Reduction Act, which is everybody brags about is this massive amount of spending into green tech and climate change. Anything with a massive amount of spending, folks, is not an Inflation Reduction Act. By in large, it is inherently inflationary because it is spending. But we heard was this solar company in Germany, who actually, in this particular for Colorado, the solar company in Germany actually changed their plans and their investments in Germany, took their equipment from Germany, and they're taking it to Colorado because of the incentives in the U.S. Now, there are tax breaks, massive incentives, and this is something that Europe is really concerned about, is their ability to compete on the green side because of all the incentives and the tax breaks and the subsidies that is being given in America. And this is problematic because it means that you're going to have you're basically throwing a lot of good money after bad energy, low BTU energy. So the ability to get that solar energy into this light bulb that you're seeing in this house is going to be extremely expensive. It's going to take a lot of that copper and a lot of that a lot of transmission lines and everything to get it built, which is going to be expensive, which is going to be costly and time consuming. Probably won't happen, but it probably will be wasteful. Now, that all being said, we know that, and people that listen to this podcast and even that don't know that. But what's interesting was this German solar company was talking about the laws in place in America. Now, I think he's wrong in terms of the enforcement of these laws, but at least on paper we have them. So we were supposed to ban imports from the province of Xinjiang, from the province the where they're having Uyghur internment camps and concentration camps and forced labor, and using forced labor to actually make these solar panels, these wind turbines, these electric vehicles, a lot of the processed metals and minerals that you're seeing all coming out of the province of Xinjiang. So we do have a ban on this, cotton included, but we haven't really enforced it. And the Biden administration actually said that they're going to continue to take solar panels from Malaysia, Vietnam, and all these other countries. Malaysia and Vietnam do not make solar panels. They are all coming from China, and they're almost exclusively coming from the province of Zhejiang, and they're coming at very, very cheap costs. And something the solar manufacturer in Germany mentioned was that the U.S. has these laws in place for the for forced labor, and he was really equating this actually to the cost side. Is that that from a human rights standpoint, this is serious, and that Europe does not even have this. But from a forced labor standpoint, it's really important because the costs are so cheap. So he was saying that China has flooded the European market with all these products, and therefore, as a European company, they cannot compete. And that's partly why they went to Colorado or coming to the U.S. Because the subsidies and everything, but also because these laws are in place. And that's really serious to think about. It means that China is flooding the market with these products in Europe, and he basically said they're below cost, and we know this. But folks, the only reason they can get those below costs is because they are not paying for the labor. And if you were looking, know I've mentioned this, but please take a look at the evidence papers from Sheffield University that are on their websites that talk about this, that talk about the forced labor, and the reasons and incentive behind this is because they don't have the labor. They don't have people coming into enough of these. Now, yes, they have young people, which we mentioned, high unemployment, but these are educated young people and they don't want to labor. So this solves a problem for them, and it allows them to flood the market with this stuff. And keep Europe very, very entrenched. So hugely problematic, and very, very entrenched in when it comes to energy, forced labor, China, the province of Xinjiang, Europe, and then now obviously the impacts of the Inflation Reduction Act and seeing foreign companies like German solar companies come to Colorado. Now, you can say that's good for maybe Colorado jobs. We'll see. I think it's important to be thinking about, is this good energy? And I think we're throwing good money after very bad energy and very bad, poor forms of energy. I think a lot of folks are on this all of the above strategy. I really don't think we need to be thinking. I mean, I'm all for the nuclear and the modular nuclear facilities that could work. I am for absolutely pro natural gas in terms of putting more natural gas into the grid. And really, I'm pro coal. And I have to say that because coal is energy security, and we cannot be competing in a global economy if we don't have energy security. You don't necessarily have to use it all at once, but you could stockpile and have it available. And you have to realize that every country in the world that has access to coal and cheap coal is going to continue to use it for as long as possible. It includes China and India. So by shutting down our coal-fired power generation here in Colorado, which we are doing left, right, and center, we're not impacting global emissions. Colorado is 0.3% of global emissions. So if we shut down every coal-fired power plant and stopped energy use tomorrow, we are not a drop in the bucket of the global economy, of the global world for emissions. So it is all for naught, and it is just destroying jobs and communities and lives. That is really, really problematic for the average consumer, the average person, and the state of energy security and the U.S. stance and power in the world. And with that, I think I should mention, I don't know if the folks have seen this, you've probably seen this, that Newsom, the governor, Gavin Newsom, governor of California, has actually went against the environmentalists within California. This is really interesting. It's good for gas producers here in the Rockies who are exporting gas to California. But because of California's blackouts, because of California's serious issues with energy security and their ability to keep the lights on, and basically in California, what you're seeing is, if you go there, you're seeing you see incredibly high gasoline prices, but also you have communities where the electric power and utilities companies are basically telling the communities to not use power at the peak time. So yes, they have power during the day because they have lots of solar and wind, particularly solar. But when it's sunny, it works. But they don't have power at night, so they can have peak load issues with that. So they're asking people to not use their power at night. And the reaction was that Gavin Newsom and California have decided to extend the life of three natural gas fired power generation plants within Southern California. And that's really serious because it means they're extended. They were supposed to be done by the end of this year, and they're now extended until at least 2026. So I'm just going to read this for context. This is a Bloomberg article, and it says, quote, the approved extension means the trio of power plants located along Southern California's coastline, the AES Alamitos, the Ormond Beach Generating Station, and the AES Huntington Beach Station will operate through 2026. Previous plans called for them to shut down by year's end, end quote. This is a real case in point, and it's something I think it is a case in point in terms of what's actually happening in the energy space, what's actually happening on the ground. California can talk the big talk. If you read this article on Bloomberg, you do hear from environmentalists who are very angry about this, and they say how easy it is to just keep, how easy it is to keep or to bring on natural gas fired power generation, but how hard it is to bring on wind and solar. And, I think those folks need to realize how difficult it is to build anything. And they're not building a natural gas fired power generation. They're just not shutting it down. So that is a reality check in terms of what's actually happening. So the difference in terms of what's said and versus what's done. Now, Gavin Newsom said they're still still on track to hit their 2045 emissions targets. But the reality is that near term, you have to be able to turn the lights on. That does mean that you're going to be pulling in natural gas from elsewhere because domestic production is declining dramatically within California. And it also means the reality check, I think, in this context of the economy. And I do want to close by talking about the U.S. economy. I think the context of rising energy prices or sticky or maintained high energy prices are really, really important to think about, and the high labor costs and everything are important to think about in the context of the overall economy and how damaging that this is to the consumer, but how it also doesn't work unless your economy is resilient. Higher energy prices and higher labor prices and higher goods prices don't work unless you have a resilient economy, and they can actually, hurt and deteriorate economy. Hence why the Fed is trying to fight inflation and why they have to maintain those higher interest rates. And so we now have this tale of maintained higher interest rates probably for longer, and we have rising, sticky energy prices rising for a number of different reasons, as we've explained. And this does not bode well for the overall economy. It really shows as we've talked about, some major cracks and weaknesses, not just within the U.S. economy, but within the Chinese economy and the global economy, all on track for a recession. And there was someone on the market today on CNBC that was talking about cheap labor, cheap energy, and cheap goods, and how we're out of that era. And, if you're like me and you spend a lot of your time looking at charts and data and you extend it back and you try to look at pre-2008 and you're looking at 2000s and you're thinking about where were energy prices, where were goods prices, where were service prices. I mean, it's really, really serious. It cannot be underscored enough is that the access to labor. I mean, we have something in the U.S. I think we really do have to appreciate in thinking about. And I want to close by talking about the Fed minutes. But if you've had, pre-COVID or during COVID, people were going crazy. They were building stuff, but you could still get people to do it. It was expensive, but you could still get people to work on your kitchen or something, or if something broke. Now, if something breaks, you almost can't get anyone to fix it. My air conditioner went out, massive cost to replace my furnace. Fortunately, knew a person that I trusted, but the cost was nearly double at what it would have been, pre-COVID. And the ability to get people or that company to even maintain the people that they had was difficult. And the actual service side, the actual maintaining of the people, led to a lot of delays, led to a lot of problems and errors and fixes and everything. If you're thinking about replacing anything or thinking about stuff that's broken, this day-to-day maintenance is now difficult to just get something serviced, and that's because people are not working. So you have to think about, so why are people not working? Partly, there's a lot of money still in the system. So I've talked about that housing lag, right? That massive amount of money that we still have a lot of money from housing, that people have equity that they still have. You have a lot of older folks that would have been in the workforce that retired early that didn't go back to work. And then you have a lot of younger people and a lot of unemployed people still out there. So I think people have to pay attention to the unemployment benefits. We still have massive unemployment benefits out there. So people are paid not to work. The Biden administration increased food stamps by 1/3 when he came into office. So we led the world in food inflation because we increased that food stamp program. And yes, there are a lot of people who need help on the food side. Absolutely. But we're talking about massive inflation. When you increase entitlement programs, you have inflation. And so when you also increase that, you disincentivize people to work. And so we have a problem where people are getting paid not to work in this country. And when you actually hear commentators, and I heard this today on multiple news outlets, was that, when we're thinking about the work from home, and we're really starting to see this where businesses are really anxious about this. And you're hearing companies like Zoom, the entity that pioneer, everybody working from home, Microsoft, you name it, all these companies that, you log on, you just do your work from home. These are the companies telling people to come back into the office, which is just ironic in and of itself. But the reason they're telling them to come back in the office is because these people aren't working and they're not productive. And it's having a huge impact in terms of real estate, because most people are, even the people that are full time are still spending, are only spending, like, the majority of their time in the office is still only a few days in the office. And that means that all the businesses from a commercial real estate standpoint are being impacted, and you're going to see a slug of commercial real estate go under. It's taking time, but it's going to happen. That impacts regional banks, but that also impacts businesses. So if you see people, restaurants that are downtown or in these areas where you normally had businesses, there's a knock-on impact to that. And so these are all these things sort of accumulating and weighing and problematic. And it means also that, so you have all these people working from home, you have people driving, you have people going to the grocery store, you have people more time on their hands. So that lends to the service inflation. So you have a lot of stuff, I think. And then just in overall spending, those entitlement programs I talked about, that government spending, that means that, you have a massive amount of government spending still in the system. When you increase those entitlement programs, and have that spend, you have that inflation in the system. And when you listen to the United Kingdom, they talk about that out loud, where the Bank of England talks about the actual, the government spending. And yet in America, we don't do that. And they are having massive and rampant labor cost inflation within the UK, but you don't hear them complaining about people not going back to work or not going back to the office. We have that here in America. People are just not going back to the office. It is a unique problem. And I think it's going to have lasting implications in terms of productivity, but also in terms of inflation, and then in terms of the health of these cities and what's going on. And I will comment on this. I'm not going to spend too much time on this, but I have to close with, I want to talk about the Fed minutes, because they were, they tie into the U.S. debt. But I want to talk about Target as well, because in terms of the spending, what's going on with the consumer. So we'll close by talking about Target earnings. We have Walmart tomorrow, the health of the consumer, the credit card spend that we saw from the Fed data, the New York Fed survey, or the New York consumer data, which talks about we have $17 trillion in U.S. household debt, and talking about the Fed minutes. Now, to close, the Fed minutes, basically the market was a little nervous because the Fed minutes essentially said that they were open to more rate hikes. And they actually, while most agreed that they should raise rates in the last meeting, which they did, they were actually open to further rate hikes. And then if you read the tea leaves, and if you actually read the Fed minutes, there's a lot in there to be concerned about. There's a lot in terms of very sticky inflation. There's a lot in there about actual global problems. And there's a lot in there about both high interest rates and sticky inflation being a problem in the future. So one of the things they said was, quote, respondents to the open market desk survey of primary dealers and survey of market participants in July continue to place significant probability of a recession occurring by the end of 2024. So one, they reiterated that. We did hear the recession talk before in a previous minutes, which got folks nervous. And they also say most survey respondents had a model expectation that a July rate hike would be the last of this tightening cycle, although most respondents also perceived that additional monetary policy tightening after the July FOMC meeting was possible. This was a pretty mixed bag. The talk and commentary goes a little back and forth, but you essentially, and then you've had Fed guys come out today in the last couple of days basically saying that we might have to hike rates because of this persistent inflation. I think the stuff on something that the Fed gets into a little bit and what's not articulated, something we're hearing with UK inflation and the Bank of England and others talking about PPI, or producer price index, or the industrial side, and how that's coming down, and that will go into the consumer price index, and we'll see lower inflation for the consumer. That's actually it's a leading indicator to a problem. It means that you're not having enough demand on the you're not having enough demand on the business side. And so you have lower prices, and that's usually a negative economic indicator, not a positive one. So I think we're getting some mixed signals here and misinterpretation of that, especially by active, pundits that are on CNBC or on Wall Street. But I think it's important to point this out. The Fed also mentions this, and probably a little more talk about the global side than they normally do. They said, quote, indicators of economic activity such as purchasing managers indexes, PMIs, pointed to a step down in the pace of foreign growth in the second quarter, reflecting fading of the impetus from China's reopening, continued anemic growth in Europe, um, some weakening of activity in Canada and Mexico, as well as a weak external demand and the slump in the high tech industry weighing on many Asian economies. That's really serious. And that gets to the point of this contagion talk that we're talking about in the Asian countries. But basically, the Fed is saying we have weakness globally, and that is problematic. The other thing I will note on the China side is that when we see this bad China data, and we're talking, and I forgot to mention, hone in on this, deflation is the word that everyone's talking about in China, and that is a big problem, because when you're seeing deflationary data, that might be slightly positive for the U.S. in terms of they're not exporting inflation, but it means that, one, we're not consuming, so we're not demanding the goods that they're exporting, and we are seeing that both in our import data and their export data. We're not demanding that, which says something about the talks. That's telling us about the health of the U.S. consumer and the U.S. economy, and it's really impacting China. And it's also saying that, so this weakening within China and their lack of exporting goods, and that deflation, when you have deflation, it means that your debt goes up. So when you have inflation, if I mortgaged my house at, if somebody mortgaged their house and had a $400,000 mortgage, and they mortgaged it, refinanced it at 3% when they were at 4%, they're still paying that, maybe whatever, it's $2,000 a month. They're paying that, and inflation is up, but they have the same mortgage price every month. When you have deflation, that actual price goes up. So in nominal terms, that value of that debt is going up. So when you think of the local government debt, and you think of the overall Chinese debt and everything you're hearing, that means it's actually bigger in real terms. So that is a major problem. It's not well understood, so it's not well discussed within the market. Okay, so that's the last bit on China. Although I think it also is important to point out that China has the treasuries, and the purchase of U.S. treasuries has really come off. And I think that's, it's saying a few things, but I do think it means they want less exposure to the U.S. in case of a decoupling, in case of anything. That could be just precautionary, but it could also be, hey, if we do something with Taiwan, or we do anything, or we want to decouple, we have the opportunity. Okay, so lastly, with U.S. household debt, and this has been really bugging me, because I've heard about the strength of the female consumer is driving the market. I don't know if you saw that on New York Times or whatever news feed was popping up on my iPhone over the weekend. Was Beyonce to Taylor Swift to the Barbie movie, is that people are spending in droves, and it's experiences, and it's just amazing. Well, people spending, as I mentioned, does not equate to a healthy consumer. And we see this in the household debt, which has reached over $17 trillion. We see that credit card debt has gone up north of $1 trillion. And we've seen student loan debt is up, auto loan debt is up. So when you add all the non-household mortgage, when you add all the non-mortgage debt up, it is about $4.6 trillion. Really high, and it's rising. And we've seen, if you look at the actual credit card debt, you see that the expansion of ability to spend on credit cards has risen, and we're seeing obviously rising credit card debt, and the average credit card interest right now is 23%. So spending on credit cards means that the consumer is not that healthy. It means that the consumer probably has flexibility in their work from home life balance, but they are spending on credit cards because of the they don't have the money. And so that does have to come home to roost. Whether it doesn't mean you have to have a crash in credit cards or credit or liquidity issues, it means that if somebody loses their job, things start getting really tricky. And this is all working because everything's moving and it's going forward, but it works until it doesn't, until the music stops and somebody doesn't have a chair. And so I think we really have to be thinking about what it means when somebody loses their job, and all these people that, we hear a lot of talk on the housing side that people want to sell their homes, but they can't or they want to move, but they can't because they can't replace that low mortgage payment. What happens when they have to? And I think that's really important, is what happens when you saw housing crash in 2008. There were a lot of different reasons for that, but people were losing their jobs, and then you had adjustable rate mortgages, and the interest rate go up, and it was crazyville. Now you actually have people buying houses on adjustable rate mortgages because it's cheaper. That has consequences in the future are problematic. All of this is going on. You have so much noise in the market. It is really difficult for me to say, yeah, I am bullish on the economy, and therefore I'm bullish on oil prices. So there's a lot of reasons oil prices can maintain stability, but it is not because of the health of the U.S. or the global economy. And I should close on that, but I have to close on one last thing, and that is the Target earnings call. It is worth a read. I think it is fascinating the stuff that they put in there. Target continues to talk about. I mean, they actually talked about all the negative stuff with regards to what's going on within the culture within the U.S. So they talk about the crime within the U.S. and they talk about the shrink. So basically, they said that crime was up, or organized theft or organized crime and theft was up 20% in the first 5 months of the year, and they basically reiterated that they would have the same shrink or loss in revenue from this theft that they're receiving, or the theft that Target is getting, and that is $1.3 trillion that they are exposed to on law, or sorry, $1.3 billion, not trillion, $1.3 billion. So it's 500 million plus another 300 million, or 400 million that they added, and they keep adding to these numbers and said they were going to maintain that number. That's a massive loss for a company of just from pure theft. That says a lot about what's going on within, these stores. And if you listen to analysts and pundits, they talked about the pushback on they had the pushback on their pride displays. Target talks about that a lot within the earnings call, which is kind of amazing, about how they had to make some changes within their displays, about how they're still selling their products, and how they're working with that. And then they talk a lot about the consumer. They talk about the Barbie movie. They talk about the theft. They talk about the lack of people spending, but they talk about pumping up stuff on the Barbie movie. They talk about Stanley cups and different colors and everything. I mean, it is a really interesting earnings call. And then if you listen to the market reaction, is basically saying, hey, if you're listening to Last Call on CNBC, you're hearing them say, hey, okay, if we separate all the political stuff outside of Target, what is their valuation? And I thought it was really interesting in terms of their price to the PE ratios on Target. They're saying, hey, they're basically in line with what they should be. And Target weakness, part of it is, forget the political stuff. And I think the theft is really, really serious. And it's serious when you're hearing about, companies like Walmart who leave cities like Chicago and Portland because of the crime, because the theft is so high and they're losing money. But I think it's really important when you're thinking about, how is that consumer doing? I mean, it was the upper middle income consumer that was shopping at Target. So, or not necessarily upper middle, but they weren't the bottom middle of the consumer. They were the higher end of the middle side. Now, Walmart is capturing a massive share. I have recently shopped at Walmart. I don't normally. I am extremely frustrated that in Colorado, if you forget a trash bag, if you forget a bag that you don't have a bag option within Walmart, you have to buy these very expensive bags. That drives me absolutely bananas. But I can tell you that a lot of people are trading down in buying and shopping at Walmart because it is so much cheaper. And Walmart has a significant share, and goes to they'll have earnings tomorrow, but Walmart has a significant share of the grocery market, like 25%. And so the margins on groceries are much thinner, but it means that they can attract people to their store, and for them, hopefully attract people into their store that are going to buy other stuff. And so they're taking that share from Walmart or from Target. And then if Target had more expensive stuff, and people aren't spending on discretionary, that all makes sense that they'd be losing that. I thought it was interesting that, but if Walmart's doing great, and if Target is not doing great, and if TJ Maxx is doing great, that tells you about the health of the economy in the U.S. It means that people are trading down, and that to me is not a positive sign for the U.S. economy, especially when you put that in the context of the credit card debt that I was just talking to. And that is what I'll end on. I will tell you that the PE ratios I think are way, way too high. Right now, you have Walmart at almost 25. It's 24.79. You have TJ Maxx at 24.27. I think that's incredibly high. And you have Target at 15.99. So people are saying, oh, maybe Target's a buy. When you have all those issues with those companies, I don't know about that. I'm not advising on the stock purchases, but I think in terms of what it means for the health of the U.S. economy, it is not painting a pretty picture. So with that, folks, that seems a little pessimistic, but knowledge is power, and you can be ahead of the markets and ahead of the curve with PetrroNerds. So thank you so much for listening. The latest podcast with Carl Rove and Harold Hamm have had outstanding reviews and have been playing really, really well. So thank you so much, guys. Talk to you soon. Bye.